Hello, investors. So we all know about this popular rule of Mr. Warren Buffett. Two rules. Rule number one is never lose money. Rule number two is don't forget rule number one. So the question comes how we can ensure that we never lose money. And the stock which I'm going to discuss today, in this talk, I try to look at this principle that am I going to lose money here? Because if you don't lose money, then you make money. And I will try to first focus on the framework that how not to lose money, and then we will discuss more about the stock. And the reason why we lose money is because of three, four reasons. We get into poor quality companies with poor financial quality, with a weaker balance sheet and cash flows. And there are enough examples in the history from many of the darling infra companies of 2007, 8 to companies which were laden by debt and they went bust. The other reason why we lose money is because we pay any valuation for the company for a company, and especially many times in current scenarios, this is a phenomenon which I have seen, picking up pace where people have started losing respect for valuation, and then market comes back and it punishes them. The third is decent business quality, because the financial quality could be good, but if the business quality is not good in terms of barrier to entry and all, slowly the financial quality could deteriorate if it is a really attractive business for somebody sitting outside. And fourth is the promoter quality, because all said and done, if everything is good but the promoter is not good, ultimately it may not reward the shareholders. So when one may not lose money is when one is looking at a strong balance sheet, cash flow, decent financial ratio based business. One is paying fair to attractive valuation. One is entering into a business which has some level of barrier to entry, which can help to company to maintain its financial quality. And then the promoter should be honest enough not to treat the minority shareholders in the wrong way. So the company which I'm going to discuss today, let me first walk you through the balance sheet of the company. And this is a company in dairy sector. The company's name is Dodla Dairy. It is one of the recent IPOs of last 2 years. So if we look at the balance sheet of the company, we can see it's almost a zero debt company, only 13 crore of borrowing. And actually, earlier 5 years back, this company used to have some borrowing, but slowly they have reduced the borrowing, and now it's almost a debt-free company. The other thing is, if we see on the asset side, net block and investments, these are the major items. So which also highlights the company has very less inventory and receivables. So if you see, most of the asset is either net block or investment or cash and bank balance. So it looks like a very healthy balance sheet. If we look at the cash flows, we can see there is a very strong EBITDA to cash flow conversion, and the EBITDA to cash flow from operation is almost 91 to 92%, which is very, very healthy. Anything above 70 is good, and 90 is for sure good. The other thing you will see, whether you look at an 8-year data or 5-year data or a 3-year data, it has always maintained exactly 91, 92% number, which tells the strong consistency in maintaining the EBITDA to cash flow conversion. And also you can see this is the 3-year cumulative average cash flow conversion and free cash flow conversion. You can see it's a very, very strong, predictable linear growth where the cash flows have grown from 44 crore to 150 crore. And not only cash flow from operation, it is one of the few businesses where there is very decent free cash flow is being generated. Almost 100 crores of free cash flow is being generated by the business, despite of the growth which the company has shown, and we will talk about it. Not many companies show this kind of free cash flow conversion from cash flow from operation. Also, when we look at the return ratios, decent 14% ROE. If we look at ROA, double digit ROA. So all the numbers are good, and these numbers are one of the best if we look at these numbers in the dairy industry compared to the peers. If we look at the growth, because it is the growth which ultimately drives the earnings. So even your ROC, everything is good, but if the growth is missing, then market may not reward the stock. Now, if we look at growth, the company had decent high single digit growth rate on sales, but the PAT EBIT growth rate has been very, very healthy, and even the cash flow growth rate has been very, very healthy. And if we see the market growth rate projection, because the company is in dairy, the dairy sector is expected to grow at 6 to 8%, and then the value added products are expected to grow at somewhere between 13 to 20%. So there is a possibility of 10-11% kind of blended growth rate for the industry, and which is reflected in how the company has grown, where at a cash flow level they've beaten, and PAT level they've beaten the growth rate of the industry.
And in practitioner membership, you get multiple courses for company analysis, where some 30 plus 40 plus companies which we have studied in the past, they are available. And every month we keep studying one or two companies. Every 3 quarter we keep studying one or two sectors. Every quarter we keep analyzing the market. Every year we keep analyzing the annual report. So all of that is built there. So it's a 70 hours of already existing content, where every year, every month we keep building 5-6 hours of content. And all of this, you also get access to our dedicated WhatsApp group, our Telegram group, which is for all the updates and normal interaction, live learning. And in practitioner, you also get a weekly community meets where we discuss concepts, we discuss open questions, we discuss company, sector, presentations, and all of that for continuous connected learning.
So now let us try to understand this sector. And if we look at the milk sector, the liquid milk, it's a 4,30,000 crore market. And out of this, 50% is internally consumed and 50% is a surplus, which is sold in the market. So 50% of this becomes 2,15,000 crore. And out of this, organized market share is 80,000 crore. And I am taking an assumption that South Indian market will be 30%, because Northeast is a relatively a smaller market, and hence 30% for South India, because Dodla Dairy is mainly present in South India in 4 states. So that becomes 24,000 crore. And Dodla's revenue is 1,700 crore, which comes as a 7% market share. And if you look at the Dodla's con calls, you will also see they are projecting that this is the kind of market share they are holding. So this is a kind of validation of the liquid milk market size. And out of this, market 50%, we know it's unorganized. Rest 50 is organized, and out of that rest 50, 30% is private and 20% is cooperative. And the share of private is growing over a period of time. And this is the rate at which the industry has grown, and it is expected to grow at a CAGR of 10 to 11%, because the liquid milk will grow in high single digit, but the value added will grow in higher double digit, and the blended growth rate will be around 10 to 11%. Now, the other important thing you need to understand about the sector is the business economics, the business operating model of the sector. And circle of competence is a very, very important concept to understand. What circle of competence means is, if you look at a milk business, apart from being a, FMCG business, it is also a logistic business, because at a daily level, every day, every morning, milk has to be procured from the farmers, from the market farmers. It will go to the chilling center, then processing center, then it will go to the various distribution hubs, and then to the retailers, and then finally to the end consumer. So it's a very, very strong logistics which need to be maintained. And the companies which are able to churn maximum efficiency out of this whole logistic operation, they are the one who are able to, do the job in the right way. And it's a very wafer thin margin business, which works on a 3-4% kind of margin. So there is no room for error. So companies which have done well, what they have done is they have done well, one on the brand side, but also they have done well on the logistic side. And how they have done well, they have picked a geography, and that is why you'll see the dairy business is a regional business. So you'll see there are North Indian players, there are South Indian players, there are state players, there are players which are leader in Gujarat, which are leader in Tamil Nadu. How they do it is basically they pick a state, they build their logistic, and then they derive the maximum juice out of that logistic, where they generate higher revenue, per unit operating expenses, per unit capex, and all of that. And only when they build expertise, then they move to the next state, and that is how they grow. So scale and the concentration of direct procurement is important. The track record of growing direct procurement with happy farmer, happy customer, and happy shareholder is important. And they should have ability to grow beyond the home state, because every state is a new challenge. And then comes the whole distribution reach and the brand equity. So any dairy company which we are analyzing, we have to think about, does the company possesses skill of circle of competence, and then scaling it to various states one by one. The other thing I want to highlight is, though value-added products are higher margin business, some of the products may not be that great because of a very high working capital management. Like a business like cheese, though it's a high margin, it's a slow-moving product, and hence there is high working capital. Or a paneer, which is a high margin product, but the big market is B2B market. So There are different aspects of these financials which we need to take into consideration. My understanding is the raw milk itself is a decent business, being a negative working capital business despite of a lower margin. And curd is a very, very good business. It's a high margin business, and also it moves faster. So ideally, we should look for companies which have higher share of pouch milk, curd, these kind of businesses which are higher on the margin and lesser on the working capital intensity, and also lesser capex required to set up the business. And if we look at history, these are some of the reports I'm citing. These are 4 5 year old report, very good reports when I started reading the sector. And actually, some of these companies have done well what was projected, done bad what was projected to be bad. And Hatson is the company which has, so we know now procurement or logistics is a big skill set, marketing is a big skill set, financial performance ultimately resultant of all of this. And Hatson gets highest score. Heritage is somewhere second, and then your Parag, Prabhat, and Quality was there, and some of these companies have not performed well. And when this report was written, Dodla was not there. So now Dodla is there. So it's important to understand where Dodla stands. If we look at Dodla, so Dodla was founded in 1995, and in South, it is the third highest player, present across 12 states. And they have, these are the numbers in terms of distribution and all of that. What is interesting is if you see, they have almost 94% of the milk, which is directly procured from farmers. Also, they are present in the cattle feed business, which helps to do a bi-directional communication with farmers. So farmers, for their cattle, they need cattle feed, and company provides cattle feed, they give milk. So, there are more than one touch points in the overall relationship. And Dodla is present both in India, and they have a small presence in Africa, and they sell milk plus value-added products. If we see the how milk business works, so basically from village level, the milk is collected at collection center, and then this is sent to bulk milk coolers, and then from their chilling center. So all the processing and different activities of milk in terms of heating, pasteurization, all of that, fat reduction, everything happens. And finally, from here, it goes to dairy processing plant, and then it goes to the distribution. So your procurement, collection, testing, pasteurization, distribution, these are the various processes. Also, if we look at Dodla, so Dodla generates almost 1/4 of revenue from value added, and 75% of revenue comes from raw milk business. Now, what is interesting is how do we identify which are the companies which are differentiated? So again, when we look at these various business processes, whether it's procurement, milk chilling, dairy processing, and sale of dairy product. In procurement, the success factor is relationship management with farmer and ultimately direct procurement share. And how can we monitor who can do well? So companies which have multiple touch points, who have longevity of relationship with the farmers, and who have higher penetration of the farmers, they are the one who will lead to higher direct procurement sales. And if we look at Dodla, Dodla is 1.09 liter to 1.21 liter is last 1 year is the direct procurement, and 88% of the payment to the farmers, and 88% of the farmers are paid directly. When we look in terms of the overall supply chain and operational efficiency, the location efficiency, the expense optimization in terms of revenue or margin optimization, freight cost optimization, ability to churn the assets, these are the things which becomes important. And that is highlighted by one, how the company has grown its overall chilling center business, and also how much of the revenue they are generating per unit logistic expenses and per unit all of per unit operating expenses. And last is the marketing, where we need to see how the company is able to reach directly to the consumers. What is the B2B versus B2C share? How much revenue they are generating, or per unit of sales and ad expenses and all. And if we compare all the companies, Hatson is like the benchmark. They are the best company, because if we look at the procurement, Hatson has 3.5 lakhs farmers, and they generate a revenue of 1.82 lakh revenue per farmer. If we look at Dodla, Dodla is 1/3 in size, but they are also almost closer to Hatson in terms of revenue generation, with 1.7 liter revenue per farmer, 1.7 lakh revenue per farmer. Heritage, it's a older player, it's a bigger size player. If you see the size, Heritage deals with 3 lakh farmer, which is almost similar to Hatson. But Heritage generates only 0.9 lakh revenue per farmer. So this is how the companies start getting differentiated. Also, when we look at in terms of supply chain, Hatson works being the biggest player and most efficient player, it works on a core EBITDA of 11 to 14%. Whereas Heritage, despite of being almost equal size of Hatsun, it works on 7 to 10% EBITDA. Whereas Dodla, despite of being 1/3 in size, Dodla is still currently is working on 10 to 12% EBITDA. So if they can reach to Hatsun size, surely because of economies of scale, there is a possibility of this EBITDA margin going up, which looks respectable. Also in terms of quality, so Hatsun maintains some 45 rigorous tests. Dodla is not close, they maintain only 18. So this is something where Dodla may need to show improvement. But these are some of the ways how we can differentiate companies. And Heritage, I couldn't find anything about this FSAI test quality, how many tests they do. But this is how I wanted to highlight that Dodla looks a very decent quality business. I would consider next to Hatsun, because earlier before Dodla, Heritage and Hatsun were two companies which I used to like. But then earlier Heritage has other issues in terms of different kinds of businesses. They had retail chain business and all, which later on they sold to Future Group, but there were a lot of issues happened post that. So Dodla I will consider next to Hatsun. So if you see the strength of Dodla, procurement is a strength where they do a direct procurement and 88% of the farmers are paid within 10 to 15 days. They have GPRS enabled electronic equipments for analyzing milk, giving milk weightage scale for the payment and all. They are in cattle feed business, so they're able to increase the touch points with the farmer. They increase touch points further by organizing training camps and all. In terms of supply chain, they are focused on 4 states. So there is a focused geography that center focused on concentration of center and center of competence. And then they have execution track record of growing with very good financials. I think next to Hatsun for last 25 years. Also, it's a pure B2C brand, so there is no B2B fear of lower margins and all of that. And they have done well in one of the toughest market like Karnataka, where the cooperative of Karnataka gets a 2 to 4 rupee subsidy, which is a very high subsidy. And despite of that, they have done well. So it proves their capabilities. If we look at the management, so he's the promoter and managing director, Mr. Sunil Reddy Dodla, and Mr. Venkat is the CEO. And actually, both of them are there from the starting of the company. And Mr. Venkat has been there for more than 25 years of the company. He manages all the operations, and Mr. Sunil drives more the strategy. So we saw how not to lose money, but next question is how to make money. And again, like I gave you a recipe of how to not lose money, I am giving you a recipe of how to make big money. And big money is made when we buy companies at the bottom of their margins with a possibility of margin expansion. We buy companies where there's a possibility of top line growth. We buy companies where there is a possibility of valuation re-rating. And then there's a track record of continuous execution. And then the overall macros should also be conducive. Now, this is something which is not in company's hand, but these are the things which are there in company's hand. Because if all this gets executed, you get a triple benefit of top line growth, bottom line growth higher than top line growth because of margin expansion. And then because everything is doing so well, there is a possibility of re-rating because we have purchased an attractive valuation, which means the overall share price can grow much beyond the top line growth. Now, if we look at Dodla's current margin and future possibilities, so on an absolute basis, 6 to 8% looks like a reasonable margin because it's a cyclic business, because there is a cyclicity in dairy business from the raw material side, even if not much cyclicity from demand side, and it is reflected. If we look at Dodla's number, they worked on a 12% margin, which was kind of one-off, but the lowest margin is 7% and highest margin is 9%. And mean margin is somewhere around 8%. So that is why I'm telling 6 to 8% looks reasonable margin, because 6% is in fact very close to 5. I would consider 7% to be a decent margin which Dodla can achieve. And currently on TTM basis, Dodla is around 7% margin, which means the chances of margin going up is higher because it can go to 9%, and it was at 5% just 2 years back. And then as the scale grows, there is an economies of scale benefit. So I feel from current 7%, there could be a scope of 1% kind of margin improvement further. And the reason why I'm telling there could be a scope of margin improvement is because of the scale. Despite of current this margin, Dodla is 1/3 of Hatsun. So if they can keep on growing, and if they can come closer to Hatsun numbers 5, 6 years down the line, there is a possibility that this margin trajectory can shift by 1-2% more. If we look at the growth, so now we know that Dodla has done a very decent growth, and the cash flow growth from operation, the free cash flow growth has been very respectable. And we can expect similar 8 to 9% kind of at least industry growth rate to happen, because they have very good financials and they're doing well. And if we look how the growth will come and what are the possibilities, so almost 20 to 25% of revenue growth can be done on current capacity. Also, they're increasing the cattle feed business by 6 times, and they're further investing into Africa international business after a pause because of COVID. And this investment has already done break even this year. So if we look at the cattle feed business, which is Orga Feed, where they have a 100% holding, this company did a 42 crore turnover with a profit of 2 crore, and they're going to increase the capacity 6x, which means there's a possibility of almost 150-200 crore of revenue to be generated from this business itself. And hence the profit can, increase further to 15-16 crore. And then these are some of the businesses where they're present in South Africa, and you can see the break even has happened. And in terms of growth, management highlights that in volume, they have been growing by 10-11% and 15% in terms of value. And they're believing that they can grow at this kind of rate. And this growth rate will come from the normal milk business, which will keep growing at 8-9%. The value-added business growing at a higher rate, and then this capital feed business, which will drive the revenues further. And they're telling this 2,000 ton capacity will go to 12,000. And then with this capacity, they are generating almost 28 crore to 30 crore of revenue for half of the year. So almost 60 crore revenue. So, they are giving a projection of almost 250 crore kind of number. Also, the maintenance capex will be around 50 crores. So you have seen this company has generated almost 150 crore of cash flow from operation, and 50 crore is the maintenance capex. Hence, the company is expected to generate 100 crore of free cash flow after the 10 to 15% kind of growth rate. So use all of this in valuing the company, because the current market cap of the company is 2850, and usually we value companies on a cash flow from operations basis, with 20x being a decent valuation for this kind of business. Now this company is available at 28x free cash flows, which is very decent in my view. So one can build their own valuation scenarios. In terms of risk, so it's a new company, IPO company, so few quarters of listing history. So management still needs to be proven in terms of how they treat minority shareholders. It's a cutthroat competition business with low margin. Execution is the key. And then there's a cooperative business which gets subsidies from the state government, so they have to fight with the cooperatives. Crude prices impact freight costs. So whenever there is a high increase in crude price, you will see some pressure on the margins coming. There's a raw material cyclicity because of procurement of raw material. There could be seasonal diseases with animals. Because of that, the supply could reduce, demand could increase, and hence, because of lesser supply, the prices could increase. So animal disease is another risk. Africa business, it's a risk because Africa is a kind of volatile geography. So the macros, currency risk, all of that. Stock, because of being a liquid stock and decent share with the promoters and FIIs, DIs, it's a illiquid stock, and hence there could be a supply pressure. Right now, the technical momentum is missing. And then companies like Amul and Hatson, they are like #1 companies in private and cooperative, so they can give a very tough fight. If we look at the charts of Dodla Dairy, so you can see the stock like IPO, most of the IPO stock, it tanked, and from 460, it created a low of 413. And then it went up, but bulk of the base has been built around this 480 price. This is where a lot of support the stock is getting. And slowly you can see some volume towers have been built. So on buy days, the buy weeks, the volumes were higher. And on the sell weeks, it has been relatively lesser. But still, as I said, the momentum is missing in the stock, and the stock is consolidating right now at these levels. So this was regarding the framework of how to not lose money, the framework of how to make money, the knowledge about the dairy sector, and what is the kind of differentiated business model which can take companies and make them do to a higher scale and do well, and all about the Dodla Dairy business. If you like the video, do subscribe, do circulate it to more and more friends. And if you have any questions, please put in the comment and let me know your views. And if there is any other stock you want me to analyze, do let me know your preferred stock name. Thank you.